Welcome back. This is the third in a series of videos that explains the discovery that the Journal of Accountancy called the missing piece in liquidity calculations. The missing piece is the current portion of fixed assets, CPFA. In my first video entitled Negative Working Capital is Not Negative, I showed how the missing piece corrects the calculation of working capital. That stimulated a decade of discussion. So in my second video, I answered the questions and the challenges raised. Most important, is the current portion of fixed asset a current asset? Now, the discovery of CPFA improved our understanding of working capital, but I think even more exciting, it also triggered a second discovery, the concept of trading capital. In this video, based on this article in the RMA Journal, you will learn how trading capital and working capital, when analyzed together, provide a deeper understanding of liquidity than was possible before. These articles can be read or downloaded on my website, sme-lending.com. Now, let's briefly review the first discovery, CPFA, which will take us logically to the second discovery, trading capital. The balance sheet divides assets and liabilities into short-term and long-term accounts. Continuing this logic, we divided owner's equity into short-term and long-term. The owner's equity invested in current assets is working capital. The owner's equity invested in fixed assets we called fixed capital. At this stage, we accepted the practice of counting the current portion of long-term debt, CPLTD, as a current liability, even though it is actually a portion of long-term liabilities. Counting CPLTD as a current liability at times makes working capital negative, but then we applied the same logic to the left side of the balance sheet. Fixed assets are not totally fixed. Each year, a portion of the fixed assets is used up to generate revenue. Logically, the name of that account is the current portion of fixed assets, CPFA. When CPFA is moved up alongside its sister account, CPLTD, negative working capital becomes positive. That was the surprising conclusion in the first video. Negative working capital is not negative. CPFA and CPLTD are sister accounts. These two accounts, and only these two accounts, are current accounts that are derived from long-term accounts. Their names reflect this duality: the current portion of fixed assets and the current portion of long-term debt. In analysis, they must be kept together. They are created together when a fixed asset is acquired and financed by a new long-term loan, and they are reduced together when the fixed asset is used to generate revenue that repays the loan. To keep CPFA and CPLTD together, we sliced off the current portion of fixed assets and moved it up into current assets to align with the current portion of long-term debt, which was already in current liabilities. But what if we take both accounts out of the calculation? Removing the current portion of fixed assets leaves only assets that turn over in their entirety, such as inventory and accounts receivable. Let's give this subset of accounts a new name: trading assets. Similarly, removing the current portion of long-term debt leaves only liabilities due in their entirety every year, such as accounts payable and short-term bank debt. Let's call them trading liabilities. And if we subtract trading liabilities from trading assets, we get a new concept of liquidity: trading capital. Now, what is exciting about this is by removing the influence of the long-term accounts, we find that there is a sub-tier of liquidity that aligns perfectly with the other tools that we use today to analyze liquidity. For example, there's a lot written today about the cash conversion cycle. In the generic version, the cycle begins with the acquisition of inventory financed by accounts payable. Inventory is eventually sold on credit, becoming accounts receivable, which is eventually converted back into cash. But the total days from purchase of inventory to cashing out typically exceeds the due date for the accounts payable. So a short-term loan or revolving line of credit from a bank is provided to pay the accounts payable on time. The cycle is complete when the inventory accounts receivable are converted back to cash to repay the loan, and the cycle starts over. But wait, where's the current portion of long-term debt? CPLTD is a current liability. And where is CPFA, a current asset? The accounts we are looking at are trading assets and trading liabilities. Neither CPFA nor CPLTD is a part of the cash conversion cycle. Another example, banks calculate how much of a credit line they are willing to grant to a business based on the quantity of acceptable current assets, inventory, and accounts receivable. Called a borrowing base, the formula sometimes also nets out accounts payable. The formula varies from bank to bank. What is consistent is all three of these accounts are part of the cash conversion cycle. You will not find in any lender's borrowing base formula the current portion of fixed assets nor the current portion of long-term debt. Only trading accounts factor into the calculation of the borrowing base for credit lines. So there is significant value to focusing on just the trading accounts while excluding the influence of the long-term accounts. But now let's turn our attention to the long-term accounts. Having separated CPFA and CPLTD from the trading cycle, to complete this picture, let's look at fixed capital on the lower right. Remember, fixed capital is the owner's capital that is invested in fixed assets. It follows logically that some of the fixed capital must be invested in the current portion of fixed assets, and the rest must be invested in the future portion of fixed assets. So let's split fixed capital into a current portion and a future portion. Notice that the allocation of owner's capital is always the difference between assets and liabilities. So trading capital is trading assets minus trading liabilities. The current portion of fixed capital is equal to the current portion of fixed assets minus the current portion of long-term debt. And the future portion of fixed capital is equal to the future portion of fixed assets minus the future portion of long-term debt. That gives us a three-part balance sheet. The original balance sheet attempted to separate current accounts from non-current accounts. The bottom section here identifies everything that is not current. The future portion of fixed assets is the quantity of fixed assets that will still be on the balance sheet at the end of the year to be used in future years. The future portion of long-term debt is the debt that is not due until future years. And the future portion of fixed capital is the owner's capital that will still be invested in fixed assets at the end of the year. Everything in the top two sections is current. That includes all trading accounts and the current portion of long-term accounts. Let's put these back together to see the complete current cycle. Current assets include all short-term trading assets plus the current portion of fixed assets. Current liabilities include all short-term trading liabilities plus the current portion of long-term debt. As always, current assets minus current liabilities gives us working capital. This working capital is larger than the old working capital because it now includes the current portion of fixed assets. This diagram also reveals that working capital can be calculated as the sum of trading capital plus the current portion of fixed capital. Okay, let's pause and look at this. What this diagram reveals is there are two tiers of liquidity. The top tier of liquidity, overall liquidity, is the current cycle because it includes all current accounts. That is, all accounts that will turn over in the current period. If we divide overall top-tier liquidity into its two component parts, we get a deeper tier of liquidity. As noted earlier, the trading cycle is consistent with a cash conversion cycle, matching only those trading liabilities that provide financing for trading assets and are repaid by turnover of trading assets. A positive trading capital indicates the trading cycle is liquid. The complementary subset of liquidity comes from the fixed asset cycle, which matches the repayment of long-term debt, specifically the current portion of long-term debt, to the portion of fixed assets that will be realized in cash in the current period to pay that debt. A positive current portion of fixed capital indicates that the fixed asset cycle is liquid in the current period. Let's put some real numbers on this three-part balance sheet to illustrate its value. The way we measure liquidity today, AT&T is illiquid. Here it reports $38 billion in current assets and $50 billion in current liabilities, which results in a negative working capital of over $12 billion. And yet AT&T pays its creditors on time and enjoys an excellent credit rating. The missing piece is CPFA. AT&T generates substantial cash flow from the use of fixed assets, which, when included in current assets, changes working capital from a negative to a positive. The discovery of CPFA reveals that AT&T's overall liquidity is strong. Working capital is a positive $13 billion. When we dig down to the second tier on the left, we find a startling discovery. AT&T has a negative trading capital. AT&T does not have enough trading assets to cover its trading liabilities. Is negative trading capital the new red flag that signals illiquidity? This may come as a surprise. AT&T is liquid because of its fixed assets. That's right, AT&T is heavily invested in fixed assets which contribute directly to revenue without transiting through trading accounts. Like Sam, who uses his truck to generate revenue to pay his truck loan, AT&T uses its substantial fixed assets to generate revenue to pay its long-term debt. But notice, it does not have much long-term debt. So the current portion of fixed assets, the portion realized in cash in the current period, far exceeds the cash needed to repay the current portion of long-term debt, which means some of the CPFA could be used to cover the excess trading liabilities. It could, but that's not what AT&T does. You can find that last graphic with AT&T's numbers in the article that we have been discussing, Trading Capital versus Working Capital, which you can download from my website. Now, we all knew that AT&T is not illiquid. Its multi-billion-dollar negative working capital was finally resolved with the discovery of CPFA. But in solving one issue, we discovered that AT&T has a negative trading capital. Is that a problem? How does AT&T pay its creditors on time without adequate trading assets? What is AT&T's strategy? Is it intentional? What are the risks? What are the options? In the next video, we will see how easy it is to demystify even the unconventional liquidity of AT&T. Now, for quick reference, on my website, under the tab called Cash Flow Book, you can print or download the one-page graphic that illustrates the two tiers of liquidity. And a little bit further down, you can print or download the two-page summary, Enhanced Ratio Analysis. That's the topic of the next video. Or you can buy the book, which covers everything in these videos and much more. So join me in the next video, and thank you for watching this one. I hope you liked it.